Welcome back to The Explainer. Today, we're diving headfirst into something huge, the high-speed, high-stakes world of capital markets. The engine that pretty much powers the entire global economy. Seriously? Have you ever stopped to think about it? How does a brand new startup get the millions it needs to build some world-changing gadget? Or, how does a government even begin to pay for a massive new highway? Well, the answer to all of that lies in this incredible system, one that's built specifically to connect these huge pools of money with really ambitious ideas. And yeah, you guessed it, that system is what we call the capital markets. So if we want to get a handle on how this thing literally funds our future, we've got to break down what it is at its core. Okay, so at its very heart, it's basically a giant matchmaking service. Think about it. It's this huge financial marketplace that connects people who have capital, like you and me, savers, investors, with the people who need that capital to grow, like big companies and even entire governments. And listen, this isn't just some dry textbook definition. This is the real deal engine of pretty much all global economic progress. So this big matchmaking game, it really happens in two main ways. First, you can buy a tiny piece of the company itself, right? An ownership share. We all know that as a stock, and that all happens in the equity market. The other way is you can basically loan the company money. You buy a bond, and they promise to pay you back, plus some interest. That's the debt market. So you've got stocks, and you've got bonds. Those are the two huge pillars of this whole system. All right, so we get it. Stocks and bonds. But how do they actually get bought and sold? Where does this happen? The easiest way to think about it is like this. Imagine getting first dibs on a brand new, hot-off-the-press product versus, buying it from somebody else later on. This whole process really happens in two distinct places. First, you have the primary market. This is where a stock or a bond is literally born. The perfect example is an IPO, an initial public offering. That's the very first time a company's stock is sold, and it goes directly from the company to the investors. But after that initial sale, well, all the trading from then on happens in the secondary market. This is what you probably picture in your head, the New York Stock Exchange, the NASDAQ, where investors are just buying and selling these existing stocks from each other, day in and day out. Okay, so who is the ringmaster of this whole circus? Who manages this incredibly complex flow of money and securities? Well, right in the middle of it all, you've got the investment banks. They're basically the essential facilitators, the grease in the gears, and they play a bunch of super critical roles. Let's just kind of follow the life cycle of a stock, shall we? First up, banks act as underwriters. They're the ones helping companies issue that brand new stock in the first place. Okay, so once those stocks are out in the wild, the banks then switch hats and facilitate all the sales and trading between investors. And after a trade is actually mated, they put on another hat and act as custodians, basically safekeeping the assets for everyone. And then finally, they handle what's called clearing and settlement, which is this super critical back office process that makes the trade official. And here's the kicker. Every single one of these jobs relies on its own set of specialized heavy-duty technology. And that right there brings us to the tech, because behind every single one of those functions is just a mountain of code. Look, it's not just supporting the market anymore. In today's world, the technology is the market. It's the invisible backbone that's holding this entire global thing together. Think about it from your perspective. It feels instantaneous, right? You pull out your phone, you click buy on a stock, and poof! It's yours. But what is actually happening in the background in that split second? Well, it's an incredibly complex, mind-bogglingly fast digital journey. So every single trade, no matter how big or small, follows this basic three-step life cycle. First is execution. That's your order getting matched up with a seller. Simple enough. Then comes clearing. This is where a central party, kind of like a referee, steps in to verify that both sides can actually make good on the deal, that the money and the stock are really there. And then finally, you have settlement. That's the official transfer of ownership. It's all a perfectly synchronized, seamless digital chain reaction. And that leads to this quote, which really nails it. Failure in one link can halt trading, leading to significant financial and regulatory consequences. Think about that. The whole system is a chain, and it is only as strong as its weakest link. One tiny IT failure, a glitch in some messaging system, a brief interruption in a data feed, and the whole thing can come to a grinding halt. We're talking massive financial and legal fallout. The stakes, they literally couldn't be any higher. Which brings us to the insane pressures that are put on the technology that runs all of this. It has to meet these three crazy demands. It's got to be unbelievably fast, it's got to be perfectly compliant with this huge web of rules, and it's got to be totally secure against some pretty immense risks. Let's talk about speed. How fast? Sub-millisecond. Just let that sink in for a second. That is less than 1,000th of a second. To even have a prayer of staying competitive, these trading platforms have to execute transactions faster than you can even blink. It's just staggering. So why this insane need for speed? Well, it's because these systems are drinking from a fire hose of what's called tick data. And that means they're processing every single price fluctuation for every single stock from every single exchange all at the same time. It is a data problem of epic proportions, and it has to be solved in real time every single second the market is open. And look, it's not just about being fast, it's also about playing by the rules. You've got these major regulations breathing down the necks of these systems. Things like MiFID 2, which demand that every trade is reported for total transparency, or Basel 3, which requires constant automated monitoring of risk. In this world, having sophisticated tech isn't a nice to have, it's literally the only way to operate without breaking the law. So you see the takeaway here, right? It all boils down to this constant high-wire balancing act. The technology has to be fast enough to actually compete, transparent enough to keep the regulators happy, and compliant enough for the whole world to trust it. It's this incredible technological feat that's being performed millions of times every single second of the trading day. And that leaves us with one final, pretty provocative question to chew on. We've built this amazing global financial system that operates at the speed of light, all run by these complex algorithms and automated systems. But as things just keep getting faster and faster, are we accidentally creating a market that's not just too big to fail, but maybe, just maybe, too fast to fail? Definitely something to think about.